Ladies and gentlemen, I want to greet you on this brisk and chilly Tuesday evening in February from where I am here in Wilmington, Delaware. It's 9 o'clock Eastern Time, and we're going to get ready to start the third part of our ongoing series of using the PowerOptions tools for radioactive traders. In just a few moments, we're going to allow some time for some of our other registrants to join us in the room. Now on tonight's presentation, of course, I am flying solo. I'll introduce myself in a few moments after we go through some brief introduction on what we're looking at today, of course. But I just wanted to encourage you that if you have questions as I'm going through some of the various tools we're going to look through tonight for researching and analyzing search results for radioactive trades, use the question pod over there on the GoToWebinar, GoToMeeting format to send me your questions, and I'll check that from time to time as we're going through the presentation. We'll also pause from time to time, of course, to invite questions to come in if you have questions or if you've written some questions down. We'll also stop occasionally and prompt you to send in those questions. We'll handle a few questions in a row and then move on to the next part of the segment. The schedule for tonight's presentation is it is scheduled from 9 p.m. Eastern Time to 10 p.m. Eastern Time. But I will be honest with you, I'll probably go a little bit over that. The past few presentations we've done in this series have gone about an hour and 15 minutes to an hour and 20 minutes, excuse me, with the presentation material, and then we stayed on an extra 10 or 15 minutes to, of course, handle extra questions. So we might go a little bit beyond that. And to address the question that just came in from Terry, is there a part 1 and part 2 already recorded and available? Yes, Terry, that is. That should have been mentioned, and the link was available in the email that was sent to you in the promotion for this. And when we first log on to the PowerOptions tools, I will show you where those are. This presentation, of course, is being recorded as well and will be included in that series. And I'll show you where those are, Terry, as we get deeper into our presentation. All right, we've got a lot to cover, so let's go ahead and get started, ladies and gentlemen. And the first thing we wanted to do, of course, is this is the PowerOptions series using the PowerOptions tools for radioactive trading. Let's just briefly review what is radioactive trading. Well, it's a limited risk approach to trading and investing. In this technique, we use put options with long stock as guaranteed protection, not as speculation. This allows us to limit our downside risk, the most we can lose on the position, and still have unlimited upside profit potential once the position is open. Now, after the position is open, we're going to apply 10 different income methods that are used to lower the initial at-risk, potentially bulletproof the position, which means we have a higher guaranteed exit than our cost basis, and earn extra profits. We'll be discussing the income methods and using the PowerOptions tools to evaluate the income methods in part 4 of our presentation next week. The radioactive trading technique was developed by Kurt Frankenberg. The full technique and the income methods are discussed in the blueprint. That's his full work that describes the radioactive trading technique and the 10 different income methods. Of course, this leads us to part 2. What is PowerOptions? What are we going to be discussing today? Well, PowerOptions is a patented suite of search and analysis tools designed for self-directed options investors. With these tools, you're able to search the universe of options in over 23 different strategies in just a second, less than a second after you've adjusted your criteria or put in your criteria. Again, we discussed that in part 1 and part 2, so we're not going to delve into the criteria this evening in setting up the search tool. Once you've identified the positions, you can quickly compare the risk versus reward and do further research and analysis, and that's what we're going to focus on this evening. And then, of course, we have additional tools to help you paper trade, track, and manage the positions, and, of course, countless educational articles and help pages. And as I mentioned, discussing the tools for paper trading, tracking, and managing the positions, the portfolio tools on PowerOptions, we're going to discuss next week in part 4 of the radioactive trading series and using the PowerOptions tools. I'll be your presenter for this evening. My name is Michael Chupka. I'm the PowerOptions Director of Education. I've had the great pleasure of working with Ernie Zarenner and the PowerOptions staff for the past 8 years. I handle a lot of coaching sessions and the education on PowerOptions. I've co-authored 2 books on options investing, one on naked puts and one on protective option strategies. I am versed in all strategies on the site, all 23 different strategies on PowerOptions, but of course tonight we're just focusing on the radioactive trading techniques and using the research and analysis tools to delve deeper once you've identified a potential radioactive profit machine, what Kurt calls the RPM. Now, I've been trading the radioactive techniques for over 2.5 years, and of course I'm very familiar with the tools in the site. The goal of these presentations is to help you get more familiar about how I'll use the tools, and how other customers have told me they use the tools to evaluate those different income methods as well. And of course, what are we covering tonight? Well, tonight we're going to cover the functionality of the PowerOptions tools to research radioactive profit machines. We're going to discuss the use of the More Information button to further research and analyze the married put positions. We're going to discuss the steps and processes to help evaluate those RPMs. Of course, this will lead us to a discussion on comparing the various strike prices after you've done some research and analysis on the stock itself. And we're going to go through running the catastrophe report and what-if scenarios, and maybe even a walkthrough of the insurance tool for special scenarios. Now, this presentation is designed to help you become more familiar with the PowerOptions tools, not only, of course, to research and analyze the RPMs, the radioactive profit machines, but also to become familiar with using the tools to research and analyze other option investing positions you might be looking to get into if you're doing other strategies as well. Now, I have to be honest with you, what tonight is not. Tonight's discussion is not going to be a strict set of rules on how you should evaluate your RPMs or your positions. Now, we're going to present an overview of the research tools, and we're going to cover as many tools as we can in the allotted time. Essentially, what we're going to go through is our processes, my process, and what I know Ernie does and what I know Kurt does when evaluating the RPMs, stock charts, and so forth. Now, these might not match your specific risk-reward analysis or your risk-reward tolerances. We're going to go through the tools so you can, as you're watching the presentation, think of which tools best apply to your process of research and analysis and which tools are best going to help you when evaluating your RPMs. You don't necessarily want to trade or want to evaluate stocks the way that I do. I might not be approaching the same style, might not have the same risk-reward tolerance that you do. So tonight's process, tonight's discussion is more on which tools you're going to be using to evaluate and research, not a strict set of rules of, oh, you only want to look for these stocks, you only want to look for these scenarios, and you only want to do this when A plus B equals C. That's not what tonight is about. Okay, but if you have in-depth questions as we're going through, no problem. We'll go ahead and analyze those. We'll discuss that as well. You're going to hear me use a lot of terms this evening, such as what I do, and sometimes when I am looking at an RPM and things of that nature, to be used as a guideline, not as a strict set of rules. Okay, Philippe came in a little bit late. He asked a similar question to Terry. He missed part 1 and part 2. Are the recordings available? Yes, let's go to that right now. I've done my introduction, done my basic description here, so let's navigate over to the PowerOptions suite of tools. Okay, so we're in the main PowerOptions screen. We're going to spend most of our time this evening in the Married Put search menu, but we're going to link to the other tools from the search menu to evaluate those positions. On the main PowerOptions page, what you want to do is go into Learning Center. And when you log onto your account, if you have a trial account right now or subscription, when you're on the main home page, go into Learning Center and click on Webinars. Let me add something in here real quick. Let me show this very quickly. Hold on one second, ladies and gentlemen. Oh, sorry. There we go. That's what I wanted to see. I apologize for this. There we go. Okay. Now this page, I want you to see this up at the top here. And what I'm going to do is just copy that very quickly, and I'll send it to everyone on the chat. This page is a public page, powerup.com/webinars.asp. I'm sending that to everyone right now. To review part 1 and part 2, when you go to the webinars page, over here on the right we have the previously recorded archived webinars. Simply click the header for PowerOptions for Radioactive Trades Archive, and there you have part 1, PowerOptions Search for Radioactive Trades, and part 2 was the open discussion from the previous webinar on using the PowerOptions search tool. So part 2 is about an hour and a half worth of attendees and registrants' questions on using the search tool, and part 1 are general guidelines and rules for using the search tool when looking for the radioactive profit machines. Okay, so that's where you can access part 1 and part 2. We are, of course, recording part 3, what we're showing right now, and we'll have that up in the archive possibly, or probably I should say, later tomorrow afternoon. All right, now let's go back to the main home menu. And let me just, for the rest of the presentation, let's just do this very quickly. I apologize. I just want to take that navigation bar off so it's off of the screen. There we go. All right. So where we're going to start now. We start where we left off with Part 1 and Part 2. We'd go into Married Put, and we'd click on Search. And this would pull up the this would pull up the listed married puts that match our criteria. For tonight's presentation, what I have done is use some of the criteria that we used during Part 1 of the discussion to get a limited list of results. These are sort of based on my personal criteria, based on my account size. Of course, I'm looking at stocks between $5 to $35, looking for some fundamentals, stocks earnings per share growth greater than 7, looking for a higher range of the percent of 52-week range, and I'll discuss why, and then you can, of course, counter that if that's not what you would look for. Some ranges of beta, of course, historical volatility, average stock volume, and so forth. Now, some of the reasoning behind why these criteria entered were described in Part 1 and Part 2 of our presentation, so you can go back and review why those are listed in here. All right, real quick question from Ron. Ron wants to know, does PowerOptions analyze Canadian stocks as well or only American stocks? We only use the American markets, the U.S. markets, stocks, and ETFs, Ron. We don't have a link to the Canadian markets and the Canadian exchanges. The PowerOptions search functions and the various strategies only look at the U.S. markets, optionable indexes, ETFs, and the standard stocks. All right. So it's Monday morning following maybe an expiration or just a day when we were entering a trade. We opened up PowerOptions, we clicked on the Married Put menu, and we went into the search tool. This pulled up our saved criteria of what we're using to research and analyze our positions. Now, what is the next step? Well, take a look at our first trade. We have VRGY. It's a lower price stock trading at $13.56. I should say it closed at $13.56 today. We're shown, following the guidelines of the radioactive trading techniques and the criteria that we put in that I would use personally to look for positions that match my fundamental and technical criteria. Again, might not be the same thing you're looking for. That's why you want to customize the search tool based on stocks that you would feel have a better probability or stocks that you feel are going to move up in price over the next 30 to 60 days. Now, we're going to buy the stock, buy the put. This is a far out in time put, 193 days out. Cost is $205, so the net debit would be $15.61. Well, we're guaranteed an exit of $15, so our maximum risk is 61 cents total on the position, or 3.9% of our invested value. Now, we added some other criteria during the data columns during the last presentation, things for the implied volatility. We had a question that came up at the end of our last presentation, so we added in some of the implied volatility ranges. We're not going to spend any time looking at those. Now, I've sorted my results from lowest maximum risk to highest. So naturally, well, VRG came up top. It has a 3.9% risk. The stock matches my range, so I'm done, right? That's all we needed to do. Well, not really. We want to make sure that this is a stock that we're comfortable trading. In our criteria, we have put in things such as we want to see stocks that are moving above the 20-day moving average or the 50-day moving average. Look for stocks that have strong earnings, and we are looking for other momentum indicators with beta and so forth. But we still want to make sure this is a stock we're comfortable in trading. So the first step when researching an RPM, the first step that I go through, and I think most of our customers do as well, is next to the position to the left. I'm going to click on the More Information button, and we'll go to Charts. Now we can take a look at the basic one-year snapshot. This will give us just a basic one-year view of our chart. Not a lot of information, some volume there during the spikes. Okay, might have been around earnings or some other events. That's not very detailed, is it? What's better to do, let's go ahead and close that window, shall we? What is better to do is when you select charts from the More Information menu, we want to go ahead and select Big Charts. Big Charts is a free charting service, and we can customize Big Charts based on different technical indicators we might want to view on the chart. Now I can select, let's start over here on the left. Let me get a little bit of a pen here. There we go. Starting over here on the left, the first thing you might want to adjust is the time frame. I'm going to go over that in a little bit. I'm not going to adjust the time frame, of course, on this first chart. And then, of course, based on what kind of time frame you can select the frequency if you want to view daily or if you want to view weekly and so forth. Now, some of the basic, this is the basic chart view. if I click on Interactive Chart up here at the top, underneath the main menu, let's go ahead and select that. I just want to draw the arrow here. It's kind of hard to see, I know, because of the text size that they use. But if I wanted to see a little bit more detailed information, right away I could just click on Interactive Chart down there at the bottom. This will pull up a Java chart where you can kind of scroll over it, and it shows you the high and the low of the various days. You have the earnings listed there, so we see that the last 4 earnings have all been positive, have been pointing up. Earnings were up during this last 52-week cycle. We have our volume ranges. Scroll down a little bit more, and we also have our MACD was added for us, and the DMI positive and negative as well. Now, we have other information. There's other information available in big charts that you can select. Okay, and see, when I went right to Interactive Chart, this is usually what I do. A lot of my customers don't like to do this too much, depending on how much information that they want to see or don't want to see, for example. But I can customize this further. I can compare it to an index if I would like. I can take a look at upper indicators here, such as the SMA. I can compare a 2-line SMA or a 3-line SMA, excuse me. We can also look at the EMAs, the exponential moving averages, a 2-line or a 3-line. Now, I selected the 2-line, went ahead and added those in there for me, and I based this on a 9-day cycle. So I have the 9-day and the 18-day moving averages. Well, if you prefer to use a 12 and 24, you could just change the SMA to 12 and then refresh it. Everyone has their own different way of how they want to view it. Some investors might even want to use a 25 to 50, for example. So I could just put 25 in that box, and then that would have the lines drawn for me. Okay, well, we're going to go back to none there. There we go. Okay, now, as far as the display of the chart itself, there are various things that you can do. You can look at linear or logarithmic. And also, if you prefer to view candlesticks, we could select that. And then, of course, if you did candlesticks, you might want to view a shorter view, maybe only a 3-month view or a shorter time frame to get more information. Or if you use mountains or line charts or dot charts or bar charts, you could use that as well. This is kind of where it comes down to personal preference on reading the chart and what you wish to view. Now, some of the lower indicators you can set. This already came up for us automatically. It was 3 selections: volume, MACD in the second box, and the DMI. Well, some of the other fields that you can select here, if we click the drop-down menu for volume, I could select to view RSI instead. I would leave volume up there, by the way. But other ones that you can select in these 3 lower indicators are the RSI, fast or slow stochastic, the Williams %R, for example, volatility accumulations, momentum indicators, percent of short interest. Let's scroll down more. You've got rolling earnings per share growth, or rolling earnings per share, I should say, PE ratio, and so forth, rolling dividends, percentage yield, and some of the other indexes, the trend, for example, and the AD lines. A lot of this information here, the rolling EPS, if I was going to use percent short interest, for example, PE ratio, PE ranges, dividends, the yield, for example, the dividend yield, I don't select to use any of these when I'm analyzing a chart only because I've already done that on PowerOptions. As we discussed in the previous ones, I will occasionally look at a PE ratio or maybe even the dividend or the dividend yield. So the information I want to see on the chart is already taken care of on PowerOptions. Now, I can choose to see it on the chart as well if I like to, but I don't select most of these as a general indication because the information is already on PowerOptions, and I can program that into the search menu if I wanted to restrict it. Okay, but things we will look for, of course, you want to see volume. I do use MACD, but a lot of my customers prefer to use the slow or the fast stochastic, typically the slow stochastic, depending on the strategy, of course. Williams %R has gained in popularity over time, and that's not something that I particularly use in my analysis, but it's just one of the things that's there for you if you wanted to view that. All right, now let's go back to just the advanced chart for a minute. I want to clean this up, and so when I'm scrolling over the chart, it's not grabbing it and doing the Java form. Now, if you just start off with the basic chart when you first open big charts, it doesn't have any of the other information there that we were looking at, the advanced information of the MACD, for example, and the DMI and the volume. And that's when we want to use the indicators, just on the basic chart. So we could go ahead and select the moving averages again. We could select the upper indicators. One thing that is popular, Bollinger Bands as well. You could select those, or if you wanted to use moving average envelopes, or even price channels. I'll just leave the Bollinger Bands on for now. And then I can manually set my lower indicators. So let's just do what we had before. Naturally, we're going to want to see the volume, and I'm also going to want to see the MACD as well, and I'll just leave that. Now, once I've selected those, I'll just scroll back up and click Draw Chart. And now we have a little bit better view of the Bollinger Bands. There's a wide gap there due to the earnings. It's the percent bandwidth really opened up there. And then, of course, we have our volume and we have the MACD. Now, without getting into a discussion, I can show you, we showed last week where there's an article on PowerOptions about using the Bollinger Bands. But without getting into discussion of the Bollinger Bands, when we look to the stock chart, however you choose to use it, whatever indicators you choose to use, what are we really looking for here? What I'm looking for is a chart pattern that matches what I feel is a stock that is going to be continuing or is going to be moving up in price in the next 30 to 60 days. Okay? So we talked about some of the functionality of big charts, but why am I here? Well, I want to find a chart that I feel is confident that may have been moving up over the last 60 to 90 days, and I feel confident is going to continue to move up in price. And everyone has a different way of viewing that, of course, but that's what I'm looking for. If I looked at this chart and I said, well, the stock was stagnating for a fair amount of time. It was just between that $9 and $10 range. Had a nice gap here, and it's moved up from that gap. It's been trading in the 13 to 14 range, but it doesn't look like there's a lot of motion, a lot of momentum, a lot of activity in the stock, however you analyze it, with whatever indicators you use. Then at this point, if you're not confident that this is a stock you feel is going to show maybe a 4, 5, or 8% increase over the next 30 to 60 days, we're essentially done with this stock. We don't need to go any further. If we're not comfortable with this chart, just go up to the top, close down big charts. We're back to the screen, and now we're going to analyze the second position. And now we have CarMax. KMX is currently trading at 34.39. We're shown that we can buy a July 38 put for 520, and this would give us a total debit of $39.59, but with a 38 put, we'd only be risking $1.59 or 4%. Okay, follow step one again. What am I going to do? I'm going to take a look at big charts. I'll click the More Information button next to CarMax. I'm going to go to Charts and then select Big Charts. Now, I didn't select to store my settings, but one thing that you can do is once you set your values for what you're looking for, and again, we'd go over to the side here and we could select our indicators for the Bollinger Bands, for example, our upper and lower indicators for volume, and continued lower volumes for that MACD, then draw the chart. What I can do down here is simply select Store Chart Settings. And what Big Charts will do is it's going to use a cookie to read which settings you want it to have saved. Now, if your browser deletes cookies or deletes information after you close a session, it would never remember these. But what you're kind of looking for is if it doesn't do that, you can have it saved. So now anytime I pull up big charts from PowerOptions, it's going to have my settings in there. And of course, if I want to change the time frame to only 3 or 6 months. And even though this stock has had a recent pullback, it has shown strong growth over the past 5 or 6 months. This is probably due to an earnings event, and I could, of course, select to see that, remember, by clicking on the interactive chart or just by selecting the earnings from the lower indicators to see if that was the cause of this decline about 2 months ago in this area. But it has had strong performance, had a little gap, and then it's continued to move up after the pullback. These are some of the things that are discussed in the blueprint, of course. Kurt mentions looking at certain chart patterns such as a cup and handle, which we kind of don't have here, but he mentions some other stock charts or stock patterns he looks for, and of course maybe looking for a stock that's been on a nice run and has had a pullback recently. Again, this more comes down to personal preference of what kind of stocks you look for, what you use to analyze the stocks. Now I'm going to say that this might be something that I might consider trading. It's not a bad chart. It's been moving up significantly. It has dropped, of course. It's had a pullback, but then it started to move up from that pullback, so it's still showing some decent momentum from that event. All right, so if I like this chart, and this is not a recommendation or suggestion, of course, but if I like this chart pattern, We're going to go ahead and close this down, and we're going to continue to research the positions. Now back on the search tool, we've already covered the charts. The next step I always do, we're analyzing the stock now, is I want to go into the company information and news. I want to take a look at the recent news headlines. This will link you to Yahoo Finance, the recent headlines. And what I typically do on the news section is I'll scroll through and just see if there's any headlines here that might cause me hesitation to enter the position. Now, in the day and age of modern blogging, for example, there's a lot of things that you might just have, some of these random titles that may or may not appeal to you. Profit off this idiot investor. I don't know if I'm going to necessarily read into that as one of my major headlines. But what I'm going to go through is look at some of the other information that's here. There's some information on auto suppliers, betting on auto suppliers. There's probably been a lot of discussion and activity. CarMax is in my mind, of course, because I think they had 3 or 4 different commercials during the Super Bowl. So they're obviously putting numbers out there. Putting dollars out there to advertise. So you want to just go through the discussion, and what go through the recent headlines. And you see recent upgrade by Oppenheimer. Is CarMax stock cheap? Things of that nature. Stocks to watch. Okay, these kind of different things. Now I know everyone has other headlines you follow. You might follow IBD, and when we were discussing the stock charts, you might have your own charting software that you like to use. But the first step's always a stock chart and then the company headlines. Really what I'm looking for in this list is occasionally, here's one that I might want to look up, CarMax board elects new directors from Thursday, January 27th. It's not so much that they elected new directors that I'm concerned with. I might want to look for other articles that are linked to that specific article that discuss what happened to the old board. Were they kicked out because performance was bad? Was it just a natural way that they were looking for a new direction? That's what caused the stock momentum. These are things I want to focus on. You'd want to focus maybe even on headlines if there's any discussion of a boardroom scandal or any possibility of discussion on earnings, for example. Chuck, I'll try to get to that at the end of the presentation. That's not in this discussion, but I'll try to answer that, Chuck, at the end of the presentation when we get to that. Okay. Sorry about that. I just saw a question come in, ladies and gentlemen. I just wanted to handle that. So you want to review the headlines to see if there's anything out there. Remember how we discussed you could view the recent earnings on big charts, whether you selected a 2-year or a 3-year, or if you wanted to go further and just look at the 3 or 6 months, see the last 2 earnings. But you can link to companyboardroom.com here and just see the last earnings and events. And of course, you've never heard of CarMax before. Verigy, for example, that first stock we looked at, if I did like the chart, what I would have done at that point, after looking at the chart and the company news, the earnings, I'd want to check the profile. I have no idea what Verigy Limited is. I have never heard it before in my life. Never heard of it, never seen it in any of my searches. So I definitely want to look at the profile to see what sector or industry they're in. Now I know we're focusing on CarMax, but I just wanted to show you the page real quick. So this gives you an idea of the sector and the industry, full-time employees, a brief business summary, key executives, for example, and then you can also link to the company website. And that's sometimes important because as a potential investor, if you go to their general homepage, they'll have an investor's link on their homepage for the company, and you can request specific questions to their customer service if you're a potential investor, if you are an investor of the company, through the investor relations. It's a quick way to get some questions answered you might have on the company, last earnings, next earnings coming up, for example, and so forth. So if you're not familiar with, and this is out in Singapore, of course, so that gives you an idea. We see here that we're in the technology and semiconductor, but it's a stock based out of Singapore. So if you're shaky about the China market or you're really exuberant about the Chinese and the Singapore market, that might be something you want to jump into. Or the Asian markets, for example, this might be something. However, if you're skeptical about the Asian markets, you might want to avoid this, depending on where their customer base is and what they're really supplying. All right. Now, let's go back to CarMax. We've looked at the stock chart. We looked at the company information. We looked at the headlines, the earnings events, and the profile. Now, from our previous discussion, you know that there's about 25 to 30 different stock criteria that we can use in the search field to narrow down our selections. I can also, remember, use the See More or Less columns button up here at the top to select, let me just circle this here, the See More or Less columns button if I wanted to view various stock data or various option data. However, if I chose to view all of the stock data and all of the option data, it would just increase the width of the screen. I'd always have to scroll to the left and scroll to the right. Now, that's not inconvenient. If those are all criteria that you use, it's an easy way to see all of them. But in this situation, we're just looking at some of the criteria that we might use based on our previous discussion to analyze some of these, to analyze the RPMs on the results page. But if I wanted to get deeper into the stock, now that we've looked at the company information and the news, I'll go to the research selection from our more information menu and go to stock research. Now the stock research page, this is also the quotes page that you can access from the top of the screen. When you first log on to PowerOptions, if I knew I was considering an RPM on CarMax, I could just type the symbol into the field here and then click quotes, and that would link me directly to the stock research page for that symbol. This gives you all of the data that we have for the stock, all of which you can filter by and screen by in the search tool. Your different ranges of, let's start over here on the left. Your symbol, the total volume today, the average stock volume, shares outstanding, short interest, market cap, for example, and some of the other basic information. The Bollinger Band ranges are down here at the bottom, percent held by institution. That's probably just not calculated correctly, and I apologize for that. The center section is mostly your fundamentals, your price to earnings, price to sales, debt equity, price book, and so forth. This stock does not pay a dividend. Dividend percent is 0. Now, the one-year range is from 1862 to 36, so we're at 91% of our 52-week high. We saw that in the stock chart. The stock had been moving up, had a pullback, but it still had some momentum. Now, again, the criteria that I put in for this particular screen was looking for momentum stocks, stocks that have been moving up, were above, where the price was above the 20-day moving average. It's in the higher range of its 52-week high because I'm trying not to fight the trend in this particular search. That doesn't mean that's something that you should use. You might feel more comfortable looking for stocks that are recently depressed or have dropped in price. Maybe you're in the 50% or 55% range of their 52-week high or their 52-week range, looking for the momentum to carry on further after that. And I'll discuss that in a little bit when we take a look at one other stock chart very quickly. Of course, we have our sector. The next earnings coming up, end of March. There's no dividend date, of course. And our volatility information, put call volume and put call open interests are over here on the right-hand side. Now, you also have your broker recommendation values. The total broker recommendation, this is based on the Zach scale. A measure of 1 is a strong buy, 2 is a buy, and 3 is a hold. So the total is 2.1, and it's dropped 0.4%. And then you have your earnings per share information over on the right as well. If you wanted to get really deeper into the stock research, there's a lot of links that you can use on this quotes page. You can look at the option. Let me just highlight these as we go through them in brief discussion. The optionable stocks in industry, the company profile, for example, and we've talked about that before in the company news, opinion indicators, the income statement, balance sheet, for example, analyst estimates. These all link you to other pages such as bar chart and bar chart as well as Zach's pages, cash flow statement, return on equity as well. So those are just extra external links that you can use to analyze the different stocks. I'm not going to go into them fully right now. We can discuss those later during the question and answer if you wanted to see some of those. But yeah, you have other external links here at the bottom of this quotes page to delve deeper into the stock depending on how much analysis you want to use. All right, so that's the stock research page. Let's go back to the main search screen. And we also saw that there's an option research page here as well. At this point, I normally will not go into the option research tool. We're going to click on it now, and I'm just going to show you what it looks like. It looks similar to what we just saw for the stock research page with some additional information. But I normally at this time will not analyze the option research yet. I'll do that later, and we'll show why, of course. But the option research page is fairly similar. We've put together some of the new symbologies for you for what's shown on Fidelity, Schwab, and PowerOptions. That's just how it's tracked in the background. You won't ever really need to use that. You have the bid and the ask price. There's no volume today, so we didn't have a low, a high, or a last. There was no volume yesterday, and there is a low open interest on this position. Now, if that was something that you would have filtered out, the open interest here is only 7. If you specifically wanted to look for an open interest of only 10 contracts, you wouldn't trade anything below 20 contracts, you would have already filtered that out in the search criteria. Okay? And of course, you have your Greeks here, your delta, gamma, theta, and vega. As we discussed in the part 1 of our presentation, there's a reason why I don't particularly focus on these when doing the radioactive trading technique. And it's because that most of these are already taken into account based on the criteria that I use for the time frame that I'm looking for my options, the percentage at risk amount, and of course the types of stocks I'm looking for. You can screen by those, but basically when I'm running a search, it's already taken care of by the percentage at risk. I'll be honest with you, these sections here, these filters here in the center of our option research page, you won't be using really any of these. You'll be looking at the percent in the money. You won't be using all of these. You'll be using some of these. You can look at the percent in the money, but we already had that on our chart. You have the time value of the ask price and the percentage time value. I don't know why that came up. Oh, I know why, because the last ask price, yeah, came up as 0. I apologize for that. But that's already something that you could use in the filters. Your probabilities, we talked about why we don't use that. And then, of course, you have your implied volatility ranges, the static implied volatility, the IV over HV. Yeah, this is a lot of data that you won't really need to use, mostly for the option you've already selected to view that in the search filter or in the results table. But one of the main unique features about this option research page is as you scroll down below, we have the historical values of the option since it was released on the market. And in the general view here, we're comparing the option bid, that's the black line, to the implied volatility. Well, I'm focusing on the put option, so I probably want to be focused, and I'm buying it when doing a married put, so I can simply change this. I want to take a look at the option ask price, and I can keep it against implied volatility or view against the stock price. And then once I select that to draw a new chart there, now we have our ask price in red. I'm sorry, the stock price is in red now, and the ask price of our put is in black. And then using the scroll bar down at the bottom, we can just go through and just see the changes on this particular option since it was released back a little bit before December. Back around December is when that option was released. All right. So you can just go through the history, and some of the other history you can view. You can view delta, the time value compared to another criteria, open interest, option volume, for example, Black-Scholes, not assigned and percent assigned. That's based on if you trade it as a covered call, or in this case a covered put, and then the implied volatility, and of course even the option last price, depending on what you wanted to look on historically, or go through the historical chart there to see what's available, and how the option has performed with the stock price itself, or as with changes in the stock price or changes in implied volatility. All right. Now I'll close that down, but I just wanted to mention again, let's just review very quickly. We've identified the positions. We looked at the first one, Verigy. We didn't like the stock chart. David pointed out to me that was the spinoff on Agilent. Thank you, David. I did not realize that. We looked at the chart. We looked at the company information, earnings events, and the profile. And when we looked at the research, when we looked at the stock research, then you could look at the option research. Now, again, I mentioned there's a reason why I don't do the option research at this point. Let's say that after I've done this so far, I've gone through the big charts, the company information, the news, and the headlines, and I'm still comfortable, and of course the stock research, I'm still comfortable with CarMax. Well, if we notice on our research, and we talked about this during the part 1, during the main search screen, there are some positions here that have multiples. For example, well, here's CarMax with the July 38. Then I also have another one. Here's CarMax with the July 37 put. It has a little bit higher risk, 4.9% compared to 4%. Why would I bother taking on a higher risk if I still have a CarMax position that has a lower risk? Now, is there a third listed on this page? No, there's not, but we do see some other ones. Here's Valero. We have 2 different ones for Valero Energy and 2 different strikes, it looks like, for Wells Fargo as well. Okay, 2 different strikes for Verigy. All right, but just focusing on the CarMax one, we started just researching the stock. We had the first position that had the lowest risk. And then we looked at the stock chart, the company information, the news, headlines, earnings and events. When we went to this detailed stock research page, we might have used some of those external links to look at some of the cash flow statements, some of the other data and information. But now we have two here. Well, is there a third that might also match my criteria? And why is that important? And this sort of gets to what Chuck asked a few minutes ago. Well, now my next step is I'm going to go right into the search by symbol tool. Now remember, the search by symbol tool we could have accessed directly when we logged on to PowerOptions. We could have clicked on Married Put, gone directly into the search by symbol tool. But now we're analyzing it from the search menu, and the reason why is now that we've looked at the stock chart, and let me pull that up again on the side here. I'll pull that open and just pull up big charts real quick. I'm going to pull it open the side for the time being. Okay? All right. So what do we have? The July 38 put, again, was the one that had that 4% risk. It had the lowest risk on the search menu. And I should have mentioned that the criteria I was using was looking for positions, married put positions, that had a maximum risk between about 3.5 to about 7%. We discussed that during the search menu. My personal preference is risk less than 7% when I'm using insurance. But as we saw, this second position also matched our criteria. Okay, it's less than about 15% in the money, less than 20% in the money, so it's only 7.6% in the money. It has a risk of 4.9%. Well, the July 36 put, this one didn't match our search results, and the reason why is because I did have a base selection there for an open interest of greater than 0. So 0 is not greater than 0, so it filtered that out. But if I could get filled at 390, this still matches my percentage at risk. It's still below my percentage at risk, and it's only 4.7% in the money. All right, now when looking at this position, what am I trying to evaluate? Why did I come to this page to look at the different strike prices when the first one had the lowest risk? Well, what we just spent the first 15 minutes of this conversation discussing is we would be looking at the chart. However you analyze the chart, whatever fundamental or technical criteria you use or what kind of chart patterns you look for, I'm looking at this chart for CarMax. I'm saying, okay, we had almost, the stock was almost up at 36. It had a pullback. I would have looked at the earnings and events to see, was that the reason for the earnings, maybe delve deeper into the earnings report. The stock sort of stabilized and then started to show some more momentum. It's back up to 34. The first put that we saw in our search results that came up in the search by symbol was the July 38 strike put with that 4% risk. If, when looking at big charts, I think to myself, I like this chart, I think it's going to, after the pullback, it's still showing some good momentum here, but the stock hasn't been above 36. It hit a new 52-week high and pulled back from that. The stock hasn't reached 38 before. If I still like this stock, and I think it's still going to continue up, but I'm more confident that I might see the stock move up to, let's say, 37 or $36 per share in the next 30 to 60 days. It is currently, remember, at 34, 39. So if I expect the stock is pretty likely to move up another point or maybe 2 points in the next 30 to 60 days, but I don't think it's going to reach 38, that's going to help me determine which strike I might want to use. Yes, this one has 0 open interest right now, but let's just overlook that for the time being. If I was more confident of the stock reaching back near that high, reaching 36, I might be okay taking the higher risk of 6%. Because as the stock moves up to this strike price, the best time to look to apply any of the bullish income methods discussed in the blueprint, that would be 1 and 3, 4, 5, and 6 essentially, is when the stock's trading right at the put strike price, or pretty close to the put strike price, taking advantage of the at-the-money bell curve. We're buying the put in the money. The 36 put is still in the money right now. We're buying the put in the money to have a lower time premium, greater protection, inherent protection. But as the stock moves up to the strike price, the time value will swell because the option is now at the money, and that's when we might make to look an adjustment. If I'm more confident the stock might be trading at around $36 in the next 30 to 60 days, I might be okay taking the higher risk because that gives me a better opportunity to apply the income methods sooner. However, if I'm more conservative and I'm using this as more of a longer-term growth, that I think that, okay, it might not be trading at 38 over the next 30 to 45 days, but I really expect the stock to continue moving, and maybe even by the next earnings, I expect to see another pop towards the positive. I know that's a lot of speculation, but if that was more of your sentiment, you might be okay taking the more conservative, lower risk and the deeper in-the-money put option. Now, Chuck, just off the cuff, I kind of answered your question, just not directly. Chuck wanted to know, can you review the ITM percentage versus risk again? I get confused why you might not want to exceed 15% when looking at the puts. Well, the general rule of the radioactive the radioactive methodology is we never go more than 20% in the money. Well, sometimes you can increase that up to 25 depending on the stock. But as you can see here, Chuck, as I go deeper in the money, the risk is lowering, right? So at July 38, we're 10.5% in the money with a 4% risk. Let me change the filters here to all results. Click on submit. And what happens? Well, hey, if I'm looking for low risk positions, why am I not just going to take this July 45 put? It's 30%, 31% in the money. It's 1140, sure, but my total cost for the stock plus put would only be 45.79, and I'd have a risk of 1.7%. Why am I not taking the lower risk? Well, looking at that chart again, what do you think the likelihood that the stock's going to be trading at 45 in the next 30 to 60 days? It's very slim. It's probably very low. So you do have a low risk, but if you just tried to put on this position, you have a low expectancy of profit. Worst case scenario, what's even worse is you might try to force yourself into a bad income method early, and that could cause you even more loss on the upside, the direction that you think the stock's going to go. Well, Chuck, you're asking questions that you're answering for yourself, okay? Chuck now wants to know, let's go back to our standard view, and I think you might want to go back and review what we discussed in the main search menu, part 1, of the search there, Chuck. This put here has a 10.5%, it's 10.5% in the money. It's at 38. And Chuck brings up a point that's valid. But isn't that a big move before you can apply the other income methods? Well, if you think that's a big move, Chuck, then you probably would have restricted your search results to only see positions that were maybe 4 or 5% in the money. You would have done that in the onset. You can set that yourself based on what you think is too big of a move or too small of a move. If you don't think the market as a whole or stocks you might research are going to move up 5 or 6% in the next 30 to 60 days, then you're right. You might not want to go 10% in the money or 7% in the money. It is based on personal preference and what your conditions, your sentiment of the market is in the stock that you're analyzing. Which is why it was really important for me to show you this page, Chuck, as we did when we reviewed in part 1 in the search tool and in the open discussion. 4.7% I don't think might be a big move for CarMax over the next 60 days. I think that based on the chart, based on what I'm analyzing, that might be okay. So what I was impressing upon you is that if I'm analyzing this position, I might look more at the 36 or even the 35 put. It is a 7.1% risk. That's not too far out of my range, and it's only 1.8% in the money. But remember, I am taking a 7% risk. So I might have to do several adjustments to cancel that risk. It's kind of a trade-off. It is a trade-off, Chuck. If you want to be more conservative, have lower risk, then you go deeper in the money, but you may be waiting longer for the stock to move up before it reasonably makes sense or logically makes sense to apply one of those 10 income methods. If you feel comfortable with the stock and you think that you want to be generating income off of this position, and I'll actually get into a discussion on that in a couple minutes, or you're looking to use this as more of an income trade or an income RPM as opposed to growth RPM, you might not need to go as deep in the money on this position. You might only be able to go 1.8% if you're comfortable with that 7% at risk or comfortable with that 6% at risk. Okay? That's personal preference. What makes you comfortable and your personal risk-reward tolerance. What I talked about at the beginning, what I'm discussing here is showing how I use the analysis tools and what I look for in a sense, but they're not strict guidelines. I'm showing you these tools so they can help you learn what tools will apply to you when you're analyzing the RPM based on your personal preference. The stocks that I trade, by the way, and we discussed this in part 1, are not the stocks that Kurt trades. Kurt likes specifically to use stocks in the IBD 50 and CAN SLIM list, and that's set in that default radioactive search. I use a different search criteria, and I also use lower price stocks because my account value is not the same size as Kurt's Fission account. He's trading with about $100,000 plus, over $100,000 in that Fission portfolio. I don't have that in my personal account, so I trade lower price stocks with different criteria based on my preference. But I'm following the rules of the blueprint. I'm keeping it less than 20% in the money, and you're right, Chuck. If I think the market is more stagnant, I'm probably not looking to go that deep in the money. I'm maybe only going 5 or 6 or 7% in the money for a risk of about, in this situation, 6% or 7%. It's give and take. Can't get something for nothing, okay? All right, so with all that in mind, ladies and gentlemen, the search by symbol tool, after you've looked at the stock chart and the company information, remember the position that you're viewing, the position that you start with is probably the one that's deepest in the money and has the lowest risk of the possible married put combinations for the stock. If you like the stock, you like the chart, the company information, nothing in the headline scared you away, and you feel confident with the position as a growth or a momentum stock, you want to go to the search by symbol tool to look at the other strikes based on the rules of the blueprint and the discussion in the blueprint, and even depending on if you are looking just to apply certain income methods, then you'd want to decide which put strike price best matches where I feel the stock might be trading in the next 45, 60 days, and am I comfortable with the risk that's offered? All right, well, let's go ahead and close that now. At this point, let's go back to our search menu, and let me highlight again our 2 CarMax positions. There's number 1, and there's number 2 for CarMax. And this was the 37. It wasn't the 36 put because I did have a limited filter of open interest of greater than 0, so the 36 put did not show up. But let's say I was more, I know it's splitting hairs when you're looking at dollar strike prices, but let's say that I was more confident with the July 37 put at this point with a 4.9% risk as opposed to the 38 with a 4% risk. Once I've looked at the search by symbol tool and I see the other search selection for CarMax here, that's when I would look at the option information. When I've narrowed down which strike price I'm going to choose, and on the search by symbol I could have linked to it as well, that's when I look at the option detail page, because now I'm trying to narrow it down. In addition to narrowing it down to that particular put strike price, I want to look at the information on that put. All right, so what have we done? We've pulled up our search results based on the criteria we had set in before, save search that we've created. We looked at the stock chart. We decided we didn't like the first one, we didn't like Verigy, so we went on to CarMax, and we decided that we liked the chart for that, and we wanted to further analyze it. We looked at the headlines, the profile if we weren't familiar with CarMax, and of course we might have looked at the earnings. We would have looked at the other detailed information in the stock research tool, used the search by symbol tool to compare the different strike prices. As you mentioned, Chuck, which one matches my personal preference? Am I more comfortable, now that I've done some analysis on the stock chart, selecting a deeper in the money put with a lower risk, or a put that's not as deep in the money that would have a higher risk but might help me apply income methods sooner? Now, well, that's great. We're looking at everything numerically. We did look at the stock chart. But now, before actually entering or considering to go forward with our July 37 put, what I'm going to want to do is look at this a little bit more graphically and perhaps run some what-if scenarios. And we're going to go a little bit in depth on that too. So let's just go ahead. We'll take our second selection now for CarMax. And we're going to go directly into the profit and loss chart. It's the third selection there in our More Information menu. Okay, and we're going to scroll over here. And as you see, it copied over for us just a basic view of 100 shares of CarMax at $34.39 and the July 37 put at $4.50. And we have our basic information here for the stock and for the put option. And our total values. Okay, so we'd invest for 100 shares, we'd invest $3,800, almost $3,890. We're guaranteed an exit of 37. So our total at risk is $189 per 100 shares, or 4.9%. And of course, we have the infinite maximum profit. Now, one thing I should mention, we spent a few minutes recently discussing the search by symbol tool and comparing the maximum risk amounts. One thing that we do have to remember is the maximum risk on those RPMs that were shown are only realized when 3 things happen. See, the maximum risk here for the CarMax position, that 4.9% with a 37 put, would only be realized if we held the stock all the way to July expiration and the stock was trading below $37 per share and we made no adjustments, that's the only time we're going to realize the maximum risk. Or if the stock completely plummeted after we opened the position and dropped down to $10 per share or $12 per share, the put would almost go to parity and we'd have the maximum risk. Okay, but barring that scenario, the only other time we're going to really lose that 4.9% again, we hold the position all the way to expiration, it's still below our put strike price, and we've made no other adjustments. We're going to be planning on making some adjustments, aren't we? Yeah, that's why we're doing this technique. We're going to look to apply the income methods as the stock moves up. And hey, if the stock gapped up 25 or 30% tomorrow or at the day after I opened a position, and I can liquidate the married put right away for a 12 or 15% gain, if that matches my goals, I won't even do an income method. I might just do that, exit the position, and look for another opportunity. Again, that's personal preference based on your SIGA model. Well, what we want to do here when we go to the profit and loss chart is, of course, we want to just see it graphically. You have the curved red line here, which shows you the profit and loss at the halfway point, April 28th, 2011. That's the profit and loss of the halfway point to July expiration. So as you see, on expiration, the sort of pink vertical line here shows us that our break-even is at $38.89, the price of the stock plus put. But really, the break-even at the halfway point is probably closer to around $36.90 or about $36.75. The stock's already at $34.39. So we're not going to need the stock to move up to $38.89 to realize a profit. That's only at expiration. But if you wanted to get a gauge of where your position might be while you're in the profit and loss chart, let's say if the stock moved up 2 points in the next, let's just say 30 days. We were talking about the stock moving up closer to our strike price. So let's say the stock, what would happen if CarMax moved up to $36.50 on March 9th? Well, I'll just go ahead and put in my expected price, select my target date, go ahead and hit calculate. And okay, so we see that if the stock had moved up, the red line is, the curved red line is now redrawn, So it's showing you the theoretical gain using the Black-Scholes pricing model to analyze the put option if the stock was trading at $36.50 on March 9th, which is right about here. So we have a gain on the position using the Black-Scholes pricing model. Now, we'd gain $211 on the stock. We wouldn't lose 1-for-1 on the put, but it is going to decline in value. So we'd have an estimated gain of about $63 off of our initial investment. Now, we could also run the reverse scenario. This is the what-if scenario in the catastrophe report. What would happen if CarMax collapsed and dropped to, let's say, $32? Dropped $2 and about 50 cents or $2.40 in the next 2 weeks. Remember, our original maximum risk was $189. So if the stock drops down in price in the next 2 weeks, we'd have a loss of $239 on the stock. The expected put value would be $131, so we'd have a loss of $108, which would be close to about maybe 2.4 or 2.5% on the position. Of course, there are a couple income methods you could use in the blueprint if the stock did decline to that price, if the stock was bearish and dropped after you first opened the position. Well, we're still not near that maximum loss yet. We've going to be taking some loss. This, of course, is also assuming volatility would remain the same. If the stock collapsed 2.5 points in one day, you might see that volatility increase, so your loss might not be as much. However, if it declined from 34.39 down to 32 gradually over the next 30 days, you might not see too much of a change in the volatility as well. Now, in addition to this process, there's something I'm going to do that's a little bit more advanced, and I want you guys to follow me, and I'm going to try to walk through it a little bit slowly, but it might be complex. We might have to review it at another time. But a common thing that we wanted to discuss, and another thing we can do here on the profit and loss chart, is discuss the obvious question of what would happen if I sold a call right now. And to do that, I'm actually going to change things up. I'm going to change the 37 put to the 36. Okay? So I'm going to clear out the July 37 put from that listing. I'm going to go to View Options. I'm going to select July. And let's do the 36 put. Yes, it had no open interest, but I'm going to see what the married put, evaluate the married put with a 36 strike put instead of the 37 that we were just looking at. And the reason why I'm doing this is because we're going to talk about what would happen if I jumped in and tried to sell a call right away. All right? Okay, so I'm adding in the 36 put. I've selected buy for my action, and we're just going to leave the quantity at 1. I'm not going to put in a price. When I click submit, since I selected the action of buy, it's just going to pull up the natural ask price. Okay? So let's just review the numbers again. This time we're using the 36 strike put option. Total investment of $38.29. Guaranteed exit of 36 now. So the maximum risk is $229 or 6%. And we still have our unlimited upside profit potential. The reason why I chose the 36 is because what would happen if we decided right now to force an income method number 1 and sell the 36 call right now? What would that look like? Well, let's go ahead and click on View Options. As many of you know, because most of you own the blueprint, this is a no-no. You don't want to do this. You want to let the stock appreciate first. But we can evaluate this on the page. And we're going to use the March option. And the reason why we're using the March option is because we're only 11 days to February expiration. So let's give us a little bit of time premium. We see here the 36 call. The bid price is at 55. The ask price is 60. So I'm going to add the 36 call. The two rules of income method number 1 is we want to wait for the stock to move up, and we want to sell a call right at or above the put strike price. Never sell a call below the put strike price. I can simulate that later if you want to. We did that a couple times in the last presentation. Well, anyway, adding the March 36 call. I'm going to select to sell 1 contract. Most of you know, what is this going to do? Well, it's going to cap our upside, and if I had sold a call below the put strike price, I would have, this is just not what I wanted. I don't like these charts. This is why we never suggested to do it. And Dieter asked, why don't you sell a call below and why? Well, Dieter, what actually typically happens if you try to sell a call too soon and you sell it below the below the put strike price, your maximum risk is going to increase, not on the downside, but on the upside, because you run into the trap where if the stock spikes, you're guaranteeing to give up your shares of stock at a much lower price than your total investment value. I'll show that in just a second, Dieter. We've got to move along. I know I'm going over time. Oh, Dieter, you say you can always roll. That's right, assuming it was a gradual movement and it had just reached it and I had enough timeliness to say, hey, it's gotten to my call strike price. Let me buy it back now for a little bit more than I paid for it and roll it to the higher strike price. Of course, since I'm looking at, since Kurt's looking at IBD stocks, sometimes those stocks tend to have a sudden gap up, sudden gap down, which would work in this benefit. But if it has a sudden gap up of 5 or 6%, you're paying 5 or 6% back now. It's breached through that strike price so quickly, you've got to roll, add more money into it, and you just took your 6% risk you wanted on the married put up to an 8 or a 9% risk where you didn't want to be to begin with. Dieter, if this is something I said last week, and I'm just going to reiterate it again, and I'm not picking on you. This is just why we don't do that. If you're a better stock picker than me, and if you're watching the market all days, and you can pick positions where you say to yourself, in this scenario, I bought the July 36 put, and I'm going to sell a March 36 call. I've greatly narrowed now my profit limit, and this is at March expiration. I've limited my window of profit to just be between 34.04 and 38.40, but the search criteria I was looking for momentum stocks that I'm expecting to move up 5 or 6% in the next 30 to 60 days. This March put is out about 39, 40 days, so it's right in that middle area. And I've capped my gain to 2.5%. Now, that's acceptable to me personally for a 39-day, but that only occurs if the stock's trading right at 36. I did lower my maximum risk on the downside a little bit. That's acceptable, okay. But I don't want to try to time my trades. Kurt's saying, don't time your trades, trade time. You'll get a better premium if you wait for the stock to move up and then sell then sell the March 36 call. Forcing yourself into a position where you generate income handicaps you. It's not something I advise doing. It's not something Kurt advises doing. I've gotten trapped with it when I first started trading radioactively. Hey, because I thought I could do this. David, good point. Looks like a butterfly spread, which is one of the strategies I don't trade. I'm always up front during the webinars. I actually didn't mention it this one, and I apologize. But several of the strategies I will never trade are short strangles, short straddles, and iron butterflies. And the reason why is because I don't like this profit and loss chart. It's too restrictive to me. And too restrictive for only a 2.5% gain. Yes, in a butterfly I'm leveraged, so my gain's higher with the premium I receive. But that's not what I'm looking to accomplish. I'm looking for growth here. I'm not trying to handicap myself. And, you know, if the stock's trading right at 35, let's say on a Friday, and then all of a sudden it just, the next couple days it moves up to, I'm sorry, let's say Friday it closes at 35.50 and I'm holding the 36 call, and Monday the market gaps up and all of a sudden CarMax opens at 37. I don't want to be here. I want to have the unlimited upside still going for me if the stock reaches 37. Oh, right, Mark. Yeah, if I consider the commissions paid, if I'm just doing 100 shares, sure, the commissions paid into the position wouldn't help me much either. Now, but most of you can see why I wouldn't do this personally. If you're a good stock selector, if you like this chart, oh, another thing, David, this would also look similar to a horizontal calendar spread, right? If I was doing a horizontal spread where I'm buying a far out in time call and selling a near-term call and using the same strike price, I'd have a very similar risk-reward profile. I do trade calendar spreads from time to time, but I do diagonals, not the horizontals, not the same strikes. All right, but there's something more I wanted to go into here when evaluating this position. Let's assume that we bought shares of CarMax at $34.39. We bought the July 36 put at $3.90. We had our original risk. But what happens if the stock did move up? Let's just say the stock did as we expected, and over the next, let's just say 15 days, let's say 20 days from today, on the 1st, on March 1st, let's say CarMax was trading at about $35.50 per share. Okay? Well, if that was the case, what could I possibly get at that time for this March 36 call, or maybe the March 37 call? Well, why don't we try and take a look at that? Since I've added it in there, I have different analysis here for the March 36, my different strike prices, July 36 put, my March 36 call. Let me use the More Information button here and go to Calculators. I'm going to go to Black-Scholes. I'm going to go to the Black-Scholes calculator for the short call I selected to sell, the March 36 call. Now remember, if I forced myself into this call now, sold it right now, we have this capped gain at 36, the March option. We'd have a maximum risk of 4.7%. We did lower it from 6%, and a potential return of 2.5%. All right, well, let's go into the Black-Scholes calculator. And what we're going to look at here, when we pull up the Black-Scholes calculator, we have the March. Here's our current stock price at $34.39. We're looking at a March call. The expiration on 3/19, 39 days from today. The volatility is 0.27. There is no dividend, so the yield is 0, and the percent interest rate is about 0.28. Now, what do I want to know? What I want to know is on March 1st, what would happen? What would my call theoretically be, the price of this call theoretically be, if the stock was trading at $35.50? March 1st would be about 20 days away, so we'd still have 19 days to the expiration. It's a little bit close, but that's okay. So I'm going to change my stock price to $35.50. I'm analyzing the 36 strike call. I'm going to leave the IV and the percent interest, of course, alone now. The percent interest rate you'll probably never change. If you're assuming a change in volatility, you could change the SIV as well. I'm going to click Use These Hypothetical Numbers. Now this will give me a calculation for the call bid and the put bid, but we're just focusing on the call bid here. Every day between now and March expiration, if our stock was trading at $35.50 and we were looking at the March 36 call. So what did I say? March 1st. What would be the premium for our 36 call if the stock was trading at this price on March 1st? Well, not too much more, but a little bit more. It'd be up to 65 cents. Okay? So why am I doing that? Well, now I can go back. Originally I took the natural bid price for this call. The March 36 call was 55 cents today because the stock's at $34.39. We have 39 days to expiration. We'll allow 20 days to pass, theoretically, and allow the stock to move up, and we could sell this call for 65 cents. Okay, and what would that give us? Well, just a little bit different, okay, just a 10-cent difference. But this is one of the reasons. Now, honestly, of course, if the stock's trading at $35.50, and I'm only 11 days or 15 days now to March expiration, first I probably might not be looking at the March series. We might be looking at the April series, or I might be looking at an income method number 4 or an income method number 3. But you know what? I can analyze that as well. We know right now, let's go back to our profit and loss chart here. I'm sorry, our Black-Scholes calculator, if I wanted to know what the bid price of my put might be, this July 36 put might be, if the stock was trading at 35.50 on March 1st, well, let me select the proper expiration date. I got to change the expiration date now to July 7/16, 158 days left. Stock's at 35.50. We'll click Use these hypothetical numbers. And this will show us the calculated call premium and the put premium. So now, on March 1st, if the stock was trading at 35.50, my expected put bid for the 36 strike put with the July expiration would be 260. And that just gives me some information that I could then use in that chart to say, okay, well, what would happen now if maybe I sold, let me clear out the call, what would happen now if I sold this July 36 put for that 260 and then ran the Black-Scholes calculator again and bought another one? You know what that would simulate is if the stock does move up to 35.50 next 20 days, what would my comparison of income method number 4 look like compared to a potential income method number 1? That's how you can use the Black-Scholes calculator and this profit and loss chart to run these theoretical prices. Now earlier, Dieter, what we were talking about, I will never enter into an RPM that has a profit and loss chart with this small of a window of profit, or I'm sorry, enter an income method onto an RPM that has this small of a profit window between the break-evens and this type of setup. Now, yeah, if it moves up gradually, sure, I can roll the call, and if it moves up gradually as I get closer to expiration, I can roll it. But if I allow the stock go up to 36.50 or 37, maybe even 38, now I got to pay $2 to buy back a call I paid 65 cents for. And the stock's only moved up $2, so I haven't gained anything. I've gained nothing on the position. I'd be better off waiting for the stock to move up to 36 and then applying income method number 1 by selling the call, or maybe even doing income method number 4 to get a better, to maybe even cancel my risk. All right? Okay. Now, I had a discussion last week, briefly. Let me just review one thing very quickly, and then we'll take questions. I had a discussion last week. I believe it was Mary had asked me, when you're running your search and you're doing these research and analysis from your search results, do you ever look at the option chain? And I thought to myself, well, why would I do that? And then I realized why. Okay, what she was looking for is if you bought the stock right now, again, CarMax at $34.39, and we bought that July 36 put, for example, that we were looking at, or the 37 put, just as a gauge, if I know my total maximum risk is $1.89, what is the current at-the-money premium going to be? All right, well, what I can do now is simply link to the option chain again. And when you link to the option chain from the married put search, I want you to see this. It pulls up the 5-strike put chain to begin with. Okay? What we want to do is just change that to the 5-strike call chain. So we'll click the drop-down menu there, change it to the 5-strike call chain. And then we see, of course, that for this particular position, for the February series, the at-the-money, well, the slightly in-the-money 34-strike call is about 80 cents of premium. The out-of-the-money is about 30 cents. Let's look at March, because that's more realistic, 39 days out in time. And sort of the at-the-money premium is about 90 cents for just out of the money and about $1.40 for the slightly in-the-money call option. Now, she was using that as a gauge, I believe, and I actually did this when I first looked at it, was to say, okay, if my maximum risk is $1.89, if the stock moved up and I was going to sell the at-the-money call as soon as it hit my strike price, could I expect to almost bulletproof the position or cancel the at-risk amount from the initial setup, from the first income method? And in this case, you know, with CarMax, it might not do that. Of course, if I'd used a deeper-in-the-money strike that had that lower risk, that would potentially do that as well. But in this case, you know, it's close. It's about 90 cents to $1, but that just gives me a gauge more of where the implied volatility is now and the premiums I can expect by looking at the money calls. Now, the reason I'm just showing this because I know this is a question a lot of customers have about what might the at-the-money call strike be. I think it's better to use that Black-Scholes pricing model to say, okay, well, if the stock did move up towards my strike price, when would I be able to sell a premium? When would I be able to sell that call, and what might it be worth at that time? But I never go into an RPM planning on saying, I'm going to do income method number 1 right away. Some of you might, perfectly fine, but that's not my approach. I want to look at the other ones as that happens. And Mary's just chiming in now. Thank you, Mary. It's great to see you here again. She was just wondering if the premiums were high in most months. Some stocks have a premium versus 40 versus 10, and we discussed that last week as well. I believe that was in the open discussion, where I run into that problem when I'm doing the growth stocks or the dividend stocks. When I have my search criteria in for the dividend-paying stocks and I'm looking for longer-term growth, things as Kraft, Johnson & Johnson, and so forth, Mary's absolutely dead on. I won't expect to see any premium with sort of the just out of the money or the at the money call premium that's maybe greater than 15 or 20 cents. With something like CarMax and Valero Energy is another one that we had in our results. They have a higher near-term premium in the close-term months. And but I like to use what I just shown there. I always like to view in that position when I'm on that profit and loss chart. Let's go back. Let me just pull that back up. As I mentioned, I like to look at the Black-Scholes pricing model to see what might this call be worth if the stock was trading at X on a given day. What is my comparison between selling it now and what I might be able to get for it? That's what I want to look for. Now, Dieter, you wanted to you asked again. So I'm always looking to make your profit on the stock, not the option. Well, we discussed this last week too. There's two different approaches. It's discussed in the blueprint too. There's kind of two different approaches when looking for radioactive profit machines. One's based on growth, where I might be looking for a stock that I feel is a long-term growth position. And when I'm looking for those types of stocks, maybe they pay a dividend, they're not fast movers, they might not have a lot of call premium, but they may pay a dividend and they may look strong over time. And those also are when I'll use the leap options, maybe the 2012 or the 2013 for limited risk. I know I'm not going to be able to do a lot of the income method adjustments, such as income method number 1 and income method number 6. I'm going to be looking more to apply income method number 4 or 4 combined with 6 because I don't ever want to limit the upside in those scenarios. Now the income ones, if I'm looking for quick income on a more momentum stock, which is, I'll agree with you, Dieter, more of what these search criteria are looking for, things such as CarMax and, as I mentioned, Valero and some of the other stocks on that list that we had in there, these might be ones that I'd be looking for income. But I'm not going to sell the call right now. There's no way I would consider selling this call as soon as I open the RPM. It just handicaps me too much. It's too much handicap. Now, let's go back. I wanted to show something else here very quickly. We're going to put back in the July 37 put. Remember, this was the one where we had our 4.9% risk, I believe. So let's just run the married put, the RPM, with the 37 strike put. 4.9% risk on the downside. My expectation is the stock's going to move up maybe 5 to 8% in the next 30 to 60 days after I did my other research and analysis. And let's say, okay, we've got this position. We're coming up to February expiration. The stock's at 34.39. Let me take a chance. Short-term premium, 11 days, just like a weekly option, a little bit more than a weekly option. What if I forced myself into the 35 call right now just to get a quick 30 or 40 cents on the position? All right? So I've got the July 37 put, sell the March 35 call, put in one contract, and it'll grab the natural bid price at 30 cents. Okay? Now, I'm not making this trade. I don't think you could pay me to enter this trade based on what I just did based on what my expectation was for the stock. If I'm expecting the stock to move up after I did my research and analysis, if I'm expecting the stock to move up 5 to 8%, 5 to 7% in the next 30 to 60 days, why am I going to limit myself to a 1% gain, just getting 30 cents, assuming the stock's trading right at 35, narrow window of potential profit, and now I have a risk of 9.3%. Not on the downside, but on the upside. If the stock gapped up, jumped up to $37 or $38 before February expiration, I'm looking at a much higher risk than I was willing to take to begin with on the downside. It's not a position I want to be in. Okay, maybe that's not fair. That call premium is too low. That 30 cents is too low because we're too close. All right, well, let's look at the March. We'll pull up that March collapsible chain by clicking on View Options. Let's sell that 35 call for 90 cents. Okay, so we'll collect more premium now. We're going to cancel most of our risk by selling that call. So we sold the March 90 call. Maximum base return of 1.9% if the stock's trading right at the put strike price. And I increased my maximum risk on the upside again to 7.9%. Yeah, I agree. That's sort of an unfair comparison because this 7.9% at risk on the upside is now assuming that the stock will be trading at maybe $40 or $50 per share. I don't think the stock would do that in the next 39 days, but I don't know. I don't know. This is not a chart I want to see. This is not a chart I want to have in my personal portfolio. And again, Dieter, what did I describe before? This is not a strict set of rules to say this is how you should always research and analyze your RPMs and this is what you should do. The blueprint isn't a strict set of rules that you should only do A, B, and C. I can only tell you how I use the tools to research and analyze the positions and what I avoid in my personal account. And these kinds of setups are what I avoid in my personal account. The profit window, this profit window is wider, absolutely, because we collected 90 cents. The best case scenario for me in this is the stock's trading right at $35 or a little bit below $35 from near this 1.9% return. I'd much rather wait to see if the stock does do as I expect and move up to $36 or $37 per share and then look to apply an income method. Now, do I know the future? Absolutely not. When I looked at the stock chart and I use my analysis and I read the chart with the settings that I use, do I know that the stock is going to move up 5 to 8%? No, I don't. I use my best judgment based on, my personal trading and what I like to look for. Now, I also don't know if the stock's going to drop 10 or 15%, and that's why I'm using put options to begin with. I don't know the future. If I knew the future, there wouldn't be a market. But I do know that this doesn't match my personal risk-reward tolerance. This type of setup where I may have to roll the position. If the stock moves above the strike price, I may have to pay into the position to roll the call, continue rolling the call. That's where a lot of people get trapped just doing covered calls, even when they're right on the direction of their stock. And this risk for me, one scenario or the other, if the stock goes to 0, or that would have lowered my risk down below that 4.9%, but if the stock gaps up and let's say went to 50, well, this is out of my range I would have taken. I'm not going to afford that. My maximum risk was 7%. I'm not going to do it. Is it highly unlikely that the stock would spike up to $50 or $60 per share? Of course it is. I know that. But I don't know the future. It could happen. And I'm not willing to take that high of a risk. All right, Mark, why would you enter RPM if IM4 has possibilities already? Huh? Okay. Why would you enter an RPM if IM number 4 has possibilities already? The difference to next put up is less than the difference in strike prices. I never do income method number 4 as soon as I open a position, Mark. I can't understand that question. You might have to elaborate on that. Oh, Mary, what I would be looking for example, in this scenario, Mary wanted to know, do you have an example of what the P&L chart should look like when you do income method number 1? Yeah, I can show an example of that. Excuse me. I can show you something that I would expect of that. Let's say that we were doing the July 37 put. Okay? And what am I going to do with income method number 1? I'm never going to sell a call below the put strike price. And I'm going to want the stock to be trading near the put strike price. So let's just run a scenario. Let's say in the next 20 days again, CarMax was trading, let's do a shorter time. Let's say in the next 14 days, CarMax moves up to 37. Okay? So let me just look at this value here. We're going to go into the Black-Scholes pricing model for I'm linking to the call, so the March 35 call. But what I'm going to analyze, let's assume it was the at-the-money strike. It was the 37 call, okay? And I want to know what the March 37 call price would theoretically be. Let's just say if the stock was trading at $36.75. And let's just take 14 days from now. So let's just use the 22nd, February 22nd, okay? So scrolling down, stock's at $36.75. 37 March call premium. All right, so I'm in this range here. And 222, wow, that's not too much, is it? It would be 94 cents, okay? Now, the difference is, yes, this premium is almost identical to what we would have received if we sold the 35 call. Remember, the March 35 call was trading at 90 cents right now. But if the stock did move up to $37 per share, $36.75 on 222. Theoretically, this February call would be worth 94 cents, but it's the 37 call. It's not the 35. What would that do to our position? Let's take a look. Okay? Let's clear this out. I'm going to select the March 37 call. We're going to sell one contract, And remember, we saw it at about 94 cents based on the Black-Scholes pricing model. So what would happen? Let's see, you guys, is it coming in okay? There we go, good. Let's go ahead and hit submit. A little bit better. And why do I say it's a little bit better? Because I've lowered my risk now below my potential percent return. My break-even window is now 10 points, okay? Because it's the 37, I'm guaranteed a price of higher than the 35 when I first opened the position. The real problem you run into with the way that the charts are drawn, of course, if I opened the position, the stock was at 34.50, for example, and we bought the 37 put initially for 450, I have to remember also that what my break-even is 38. Right? Originally, without this call for 94 cents, my break-even would be about 30 on the upside with just the married put, would be about 38.95, right? So if my total debit into the position, just looking at numbers, if my total debit of stock plus put is about 38.95, if I'm not getting $1.95 for that 37 call to balance it out, worst case scenario, stock goes up to 100, you know, I've capped my gains on the downside. I'm not getting anything more when the delta goes to 1. What I would prefer to do, let me think if I can recall this right off the top. Let me show you a profit and loss chart I like, Mary, using old historical numbers. Let's clear all of this out. And we're going to do a theoretical example of what you've seen before, Mary. Remember the silver wheaten position that we discussed back in May when we originally opened the silver wheaten position, and the first income method number 1 was done 30 days after we opened the position. 100 shares of silver wheaten were bought at $17.20. At the time, we bought about a 5-month output, so I'm going to simulate that with the September strike puts. Yes, the stock price is at $35.17, I understand that, but the numbers will show us the same graph. So, we bought a 20 strike put. I'm not going to be able to do it. Yes, I am. Okay, I bought a 20 strike put for $4.30. Okay? Now, don't look at the exact stock and the exact numbers, and I'm sorry, the numbers and the dates in the scenario. It's not going to show me what we want to do. But this was accurate. This is what I wanted to show you. Here were the numbers. Total purchase price was $21.50, only risking $150 per 100 shares or 7%. And you remember what happened after that. The stock moved up, and we sold about a 30-day out 21 strike call. I don't know if I'm going to have it. I might not be able to do this. Oh, excellent. Okay. So about 30 days in, the stock had moved up, and we were able to sell a 21 strike call. In this case, it was the August 21 call for $1.48 because the stock moved up. Now, what do I have? I have a 20 strike put. I have a far out 20 strike put, a 1 month out 21 call that I received $1.48 for. Now, what did that profit and loss chart look like? That is what I would prefer to see. What's different about this position? What's different about this profit and loss chart for what we saw with income method number 1s earlier? Well, the max risk is lowered, the percentage return is still high, and even as the stock moved up significantly from our short call strike price, I'm still not taking a risk. I'm still not dropping below that break-even line. These are the type of income method number 1s I look for. When I see a chart like that after the stock has moved up, that's what I'm looking to, where yes, my maximum profit might have fallen off if the stock continues to spike above the short call strike price, but I'm still making a profit. I'm not dipping back below the break-even line. Was that an extreme situation and a fortunate situation because the stock had moved up so quickly after I got into it? Yes, I can't ignore that. I can't deny that either. It exceeded my expectations, and I was able to do income method number 1 to almost bulletproof the RPM within the first 30 days, and that's why I did it. That's why I very rarely personally use income method number 1 as the first income method. I'll use 6 because it won't limit my upside, and then I'll go from there. Okay, Mark says, he did elaborate on that. If you bought the 36 put right now, let's go back to the CarMax position. If you bought the 36 put and it only cost 50 cents more to buy the 37, it seems like an automatic IM4 to roll it up. Well, let's analyze that. I don't think that's a good idea. Let's see why. Let's go back to CarMax, okay? Oh, 34.39, thank you. And we said, what if we bought the 36 put, the July 36 put? Let's start with that position. Remember paying $3.90 for it. So buy one put, $3.90. Let's hit submit. All right, so there's our 6% risk. Now let's simulate an income method number 4 right away. Let's go back to July. I'm going to add the 36 put right back in, and then add the 37 put. So what am I doing here? I just got in the position. I sell to close my 36 strike put for $3.80. Buy to open the 37 put at $4.50. My original at risk before this initial income method number 4, when I opened it, my initial at risk is 6% and an infinite upside profit potential. Okay, let's go ahead and click submit. Okay, we lowered it down to 5.1% by doing that adjustment. Originally we had a 6% at risk. Okay? By doing this income method number 4 right away because of the short 50-cent difference that Mark noticed, so we would have lowered our risk to 5.1%. But you know what, Mark? Where am I now? I've got a 37 strike put. I'm going to wait for the stock to move up to 37 before looking to do the other income methods. Why wouldn't I have just done the 37 put in the first place? Had a 4.9% risk, a little bit lower to begin with. If you notice that, see, what I remember you asking this question earlier, Mark, if you notice that discrepancy and you say, wouldn't it make sense to do an income method number 4 right away? No, I would have just bought the 37 put to begin with. I was using the 36 strike put because that was my expectation of where the stock is more likely to be trading right away. I'm sorry, in the next 30 to 60 days. When I open an RPM with one strike, I'm not going to look to do an income method number 4 right away because I'm not gaining anything. I did gain in this situation by rolling. If you rolled from the 36 to the 37 put, you would have dropped your at risk from 6% down to 5.1. But why not just start with a 37 put to begin with? You'd have a lower at risk than the start, and then your expectation is still the same. We're now waiting for the stock to be trading up near 37 to look to apply one of the various income methods. All right. Well, I'm going to navigate away from the menu. I'm going to go back to our slide presentation and wrap up. If you have other questions, send them in. I wanted to keep this under an hour and a half, but I knew that when we got into that profit and loss chart, we were going to get a little bit deeper. Okay. Yeah, I'm sorry, Mark. I was considering the 36 because when I looked at the first part of my research and analysis, I thought it was more likely. After we looked at the stock chart, company information, news, and profile, we were looking at the 37 put. But when I looked at the search by symbol, I was more confident. I was more comfortable with the 36 put with like that 6% risk because I thought the stock was more likely to be trading at that price to begin with. But of course, if I was comfortable the stock would be trading near 37, I would have selected that. If I was 36 days, I would have selected the 37 with the lower at risk. That's the personal preference, and that's why we go through these steps. When we first pull up our search results, we've got our married puts. What do? We look at the stock chart first. Best to use Big Chart to customize your setting. This helps you determine what are you looking for. You're looking for what is my feeling, what is my expectation, what is my analysis of where the stock might be trading in the next 30 to 60 days. Then, of course, you want to look at the company information. Take a look at those headlines. See if there's anything that might cause you hesitation and in a position. If you don't know the stock, of course, take a look at the profile and then the earnings and events. And then step 3, the detailed research tool. Look at the stock detail. Or you can look at the option detail, but I like to narrow down the strike price first before taking a look at the option detail. But the stock detail, remember, we have the full numerical data on the stock, fundamental and technical criteria, and on that stock quotes page, there are other links to further information for analysis. We had things in there such as the opinion indicators, cash flow estimates, and so forth. Okay. First 3 steps, when you have your search result, research and analyze the stock. Stock chart, take a look at the company information menu. Company information. And then the research, the detailed research tool. Once you're comfortable with the stock, you've narrowed it down to the stock. And remember, if you have your first result and you go to Big Charts for the first step and you don't like the chart, close the window. Close the Big Charts down, stop looking at that stock, move to your second selection. Look at the chart. If you're not comfortable with that one, just move to your third selection. Okay? And then, if you did find a stock that you liked, and then you went to the company info and you saw some recent headlines that seemed a little bit disastrous to you or caused you hesitation, close down the window, move on to the next stock, and start all over. Go to big charts, recent headlines, and so forth. All right, now to further analyze the option in the RPM, now that you've looked at the stock chart, the company information, the detailed stock research page, and maybe some of those more advanced links, go to the search by symbol tool. Compare the risks of the different strikes. Now that you've looked at the chart and you have sort of an estimation of where you think the stock might be trading, what strike price might you want to select, and does that match your risk tolerance? Does it still match your risk criteria? You may want to link to the option chain to view current premiums or see what you're dealing with, as Mary mentioned, as far as the near-term calls. And near-term calls 10 or 15 cents, or are they 40 or 50 cents? What are we looking at there with premium? That's not saying you're going to jump into an income method number one right away. It's just giving you a gauge. And then, of course, you always want to use the profit and loss chart to run those what-if scenarios, the catastrophe report. If you have a sudden thought of, hey, I'd like to sell income method number one, or I'd like to sell this call right now, run that profit and loss chart first. And if you look at that chart, to me, Dieter, you might be able to trade those. You might be a more advanced trader and follow the market more closely than I do, where that 10 profit and loss chart is something you like to generate premium right away and you're actively rolling. That's not a scenario that I prefer. It's not a strategy. It's not a P&L graph that I like that matches my risk-reward tolerance, so I won't do that. And I never recommend doing it. Follow the rules in the blueprint. Never sell a call below the put strike price. Wait for the stock to move, and make sure you're generating at least maybe a third of the premium of the at-risk amount. But what is also useful in the profit and loss chart is if you simulate selling a call right away, you can go to the Black-Scholes calculator and say, okay, how would this look different if I then sold a call at a different strike? If the stock moved up 5 to 8% and I sold the call 20 days from now, what would be my new premium be, and what might that look like? Is it better? Do I have a much better profit and loss chart in that scenario than trying to force the income method right now? And you usually will have that. You'll have a better scenario if you wait and use income method number one at a later date when the stock has moved up in price. All right. Now just to review the price, of course, the 20-minute delayed service is $59.95 per month, discounted rate of $600 for the year. The PowerOptions real-time service, $79.90 per month, or the discounted rate of $800 for the year. The historical data, access to the historical tool is not included on the real-time or the 20-minute delayed. You can access 3 months of historical data for $99.95. But if you're already on the real-time service, it's cheaper just to upgrade to the professional level of service. It's only $20 extra per month, $99 per month, or $1,000 per year to have the real-time access on all the tools, searches, and capability. But with unlimited access to the historical suite of tools. Okay. All right. Okay, I'm sorry. So the remaining schedule on Wednesday, February 16th, 9 p.m. Eastern Time. Continuing along with this presentation, Part 4 is going to be using the portfolio tools to track and manage the RPMs. Wednesday, February 23rd at 9 p.m. Eastern Time. Oh, I didn't capitalize that. That looks bad. I'm sorry. 9 p.m. Eastern Time. Part 5 is going to be an open discussion, just question and answer on what we discussed here. I apologize, what we discussed tonight with the analyzing and researching and the portfolio tools combined in one. And, of course, we may have continuing education going on in March on the different PowerOptions tools for other strategies in addition to radioactive trading. And I want to remind everyone, of course, every Friday at 4:30 p.m. Eastern Time, I do host an open discussion presentation. So if you have questions that you want to ask during the webinar reviewing one of those tools, sign up for the Friday 4:30 p.m. Eastern Time presentation, and you can bring your questions from this presentation just on the research and analysis, research and analyzing the RPMs to that presentation. I'll be more than happy to answer them. Dieter, I believe Greg already took care of that this afternoon. Okay. And if there are any other questions, of course, you can email me at any time to support@powerop.com. You can call us toll-free during market hours at 877-992-7971. Or if you live outside the continental United States, you can reach us at 302-992-7971. Of course, there are contact links on every PowerOptions page. Dieter, I will check to make sure, but I'm pretty sure Greg told me he took care of that. I just want to verify that. Okay. Let's see. Wanda, I'm glad you enjoyed the information. I hope you got a lot of useful detail and information. And please, again, feel free to email me or give me a call if you think of any questions later on or tomorrow. Wow, an hour and 40 minutes. I'm not good at respecting your time, ladies and gentlemen. I apologize for that. Well, if there are no further questions, I'm going to say thank you for joining me. It was great to have you all here. I appreciate the questions. I appreciate the feedback and all the interaction. I look forward to seeing all of you at our next presentations coming up. Terry, yeah, there's a lot of information in this presentation. Went a little long there in the tooth towards the end, but you're welcome, and I'm glad you made it. And just remember, everyone, that link I sent you, powerop.com/webinars.asp. You can also access. Oops, I apologize. Hold on one second. There you go. Remember, if you also just go to the main home menu and you go into Learning Center, click on Webinars. That'll take you to that public page, powerop.com/webinars.asp. Over on the right-hand side are your previously recorded webinars. If you click the header for Power Options for Radioactive Trades, there's Part 1, using the search tool for radioactive trades. And Part 2 was that open forum Q&A session on just using the search tool. And Part 3, this particular archive should be up there tomorrow afternoon after it's had a chance to convert. Okay. All right. All right. Oh, hold on one second. I apologize, ladies and gentlemen. Just okay. Thanks, Danny. Daniel, it's good to see you. All right, David, I'm glad you enjoyed it as well. Look forward to seeing you at some of our next presentations also. Everyone, these presentations that we're doing for this radioactive trading series, and most of the presentations we do during the week are completely free, so I look forward to seeing you there. Ladies and gentlemen, have a fantastic evening once again. Thank you for joining me tonight. It's great to see you here. Thank you for the great questions and the feedback. We'll see you at the next presentation. Take care now. Happy trading. Good night.